Ever look at a company's results and just get that feeling?
Yeah.
Like there's more going on beneath the surface, maybe some future costs lurking.
Yeah, those hidden obligations.
Exactly. Today, we're going to try and shed some light on that. We're digging into financial provisions and contingencies.
Right. Think of it as understanding the what-ifs that companies have to account for.
We've got this document, Contingencies and Provisions.pdf, that we're using as our guide.
Mm-hmm. And our goal is really to unpack these terms, which can sound a bit complex, and figure out why they actually matter, for understanding how healthy a company really is.
Okay, let's jump right in. Provisions. What are we actually talking about here, in simple terms?
Okay, so at its heart, a provision, and this is kind of similar under both IFRS and US GAAP, it's basically a liability. But the tricky part is you don't know exactly when you'll have to pay it or precisely how much it'll be.
So it's a debt, but it's fuzzy.
A bit fuzzy on the timing or amount, yeah. It comes from something that already happened, a past event, but the settlement details are uncertain. You could almost think of it as the company saying, okay, we know something's likely coming down the track financially.
And understanding that helps you see potential problems early.
Definitely. It lets you look past just the profit number. If you see provisions suddenly jump up, that could be a flag, maybe some challenges ahead that aren't obvious otherwise.
Got it. So under IFRS, the international standards, how does a company know when to record one of these provisions?
Right. IFRS lays out 3 specific criteria. Got to meet all 3. First, there has to be a present obligation because of a past event.
An obligation? Like a legal contract?
Could be legal, yeah. Or it could be what they call constructive. That's more like the company's actions or statements have created a valid expectation that they'll fulfill some responsibility even without a formal contract.
Okay, so present obligation from a past event. What's number 2?
Second, it needs to be probable that the company will have to give up resources, usually cash, to settle that obligation.
Probable. There's that word. What's the threshold?
Under IFRS, probable just means more likely than not. So think greater than 50% chance.
Okay, over 50%. And the third thing?
Third, you need to be able to make a reliable estimate of how much that obligation will cost.
Right, reliable estimate.
Mm-hmm.
So present obligation, probable outflow, reliable estimate. Makes sense. How do they figure out the amount?
It should be the best estimate of what it'll cost to settle things. Now, what's interesting is if you've got a lot of similar items, think product warranties on thousands of TVs, for example, then IFRS often suggests using an expected value method. You look at all the possible outcomes, weigh them by how likely they are, and calculate the average expected cost.
Okay. Like a weighted average of the possibilities. What about US GAAP? How does it handle estimating the amount?
There are some differences, yeah. Under US GAAP, if you've got a range of possible costs, and one specific number in that range seems the most likely outcome, then that's generally the amount you accrue. But if there isn't one single most likely amount, if all the amounts in the range seem equally possible,
Then what?
then US GAAP usually says you accrue the minimum amount in that range.
So IFRS might use an expected value across possibilities, while US GAAP might pick the most likely single number or else the minimum of a range.
Exactly. And the document also notes that US GAAP sometimes doesn't have quite as specific guidance as IFRS for dealing with those large populations of similar items, like the warranties we mentioned.
Interesting. So you can already see some different approaches emerging. IFRS may be a bit more principles-based, looking at likelihoods, while US GAAP perhaps more rules-based, sometimes leaning towards the minimum estimate.
That's a fair summary of the general tendency, yeah. Different philosophies almost.
Okay, so those are provisions, recognized liabilities, uncertainty involved. What about these other terms? Contingent liabilities and contingent assets.
Right. This is a really important distinction, especially under IFRS. Generally speaking, contingent liabilities and contingent assets are not recognized in the main financial statements.
So they don't hit the balance sheet like provisions do.
Correct. They're kind of potential issues or potential gains, but they haven't met the criteria for full recognition yet.
Explain that a bit more. What makes something a contingent liability?
Okay, under IFRS, it's one of 2 things. Either it's a possible obligation from a past event, but its existence depends entirely on some uncertain future event happening or not happening, something outside the company's control.
Like the outcome of a lawsuit, maybe?
That could be an example, yes. Or the second possibility is it is a present obligation from a past event, but it's not recognized because either it's not probable that resources will flow out or you just can't measure the amount reliably enough yet.
So it fails one of those provision criteria we talked about, probability or measurement.
Exactly. And a contingent asset is similar, but on the flip side, it's a possible asset from a past event, whose existence will only be confirmed by some uncertain future event outside the company's control. Think maybe a potential insurance claim payout.
So these contingent items are kind of hanging out there, but not officially on the books. Are they just ignored then?
Oh no, not ignored. They need to be disclosed. IFRS says companies have to disclose contingent liabilities in the notes to the financial statements, unless the chance of an outflow is really remote, like very unlikely.
Okay, so disclose unless it's super unlikely. What about contingent assets?
Contingent assets get disclosed too, but only if the inflow of economic benefits is considered probable.
Ah, so a higher bar for disclosing potential good news than potential bad news. Disclose probable assets, disclose possible liabilities unless they're remote.
You got it. That reflects accounting conservatism generally.
Okay, that clarifies the basic definitions. Now let's really dig into those differences between IFRS and US GAAP you mentioned earlier. It sounded like even the words they use can be different.
Yeah, that's a big one. US GAAP often uses the term loss contingencies, and that term can actually be broader than the IFRS definition of provisions.
Oh, so?
While something that IFRS would definitely call a provision and put on the balance sheet might sometimes fall under the umbrella of what US GAAP guidance refers to as a contingent liability, even though it might get recognized. The terminology overlap can be confusing if you're not careful.
Wow. Okay. So the same label could mean slightly different things or apply to things treated differently depending on which set of rules you're using. That's vital for anyone comparing companies globally.
Absolutely crucial. And another key difference is the threshold for recognition. We said IFRS uses probable, meaning more likely than not, for provisions.
Right, 50%.
US GAAP also uses the word probable for recognizing its loss contingencies, but interpretation matters. It's often taken to mean a higher level of likelihood than the IFRS definition. Think maybe likely rather than just more likely than not.
So it might be harder to get something recognized as a liability under US GAAP.
Potentially, yes, the threshold can be higher. Under US GAAP, you accrue a loss contingency if it's probable that a liability has been incurred or an asset impaired, and you can reasonably estimate the amount of the loss.
And we talked about the range estimate. US GAAP takes the minimum if no single number is most likely.
Correct. Whereas IFRS might lean towards the best estimate or expected value. Also, the document points out that US GAAP often requires more detailed disclosures about contingencies in the notes compared to IFRS.
Okay, let's make this concrete. The document mentions restructuring costs. How would they be treated differently?
Well, IFRS is quite specific. You can only recognize a provision for restructuring when you have a detailed formal plan and you've raised a valid expectation in those affected, meaning you've started communicating it or implementing it.
So pretty strict criteria.
Yeah. US GAAP also has rules, of course, but the timing might differ. In some cases, US GAAP might allow recognition a bit earlier in the process than IFRS would permit.
What about paying termination benefits to employees who are being laid off?
Similar story with timing differences. IFRS says recognize it when the company is demonstrably committed to the termination plan. US GAAP's triggers might be tied more specifically to when the plan is communicated and what actions have already been taken. It can get quite granular.
Okay. The document also mentions onerous contracts. What are those, and is there a difference?
An onerous contract is basically a bad deal. A contract where the unavoidable costs of fulfilling it are higher than the economic benefits you expect to get from it.
Coach.
Yeah. Now, IFRS specifically requires you to recognize a provision for the estimated loss on an onerous contract.
Makes sense. You know you're going to lose money on it. Does US GAAP do the same?
US GAAP addresses burdensome contracts too, though the specific guidance might differ slightly. But one area where they generally agree is on future operating losses.
Ah, right. You can't just create a provision because you think you might lose money next year.
Exactly. Both IFRS and US GAAP generally prohibit recognizing provisions for future operating losses that aren't tied to a specific existing obligation like an onerous contract. Provisions look back at past events, not forward at general business pessimism.
Got it. What about guarantees? Like if a company guarantees another company's debt.
For guarantees, IFRS requires a provision if it becomes probable that the company will have to make a payment under that guarantee. US GAAP also has guidance on guarantees, focusing again on the probability of payment and the ability to estimate the loss. The underlying principle is similar, but application details might vary.
Okay. Self-insurance is an interesting one, like a
Mhm.
company deciding not to buy external insurance, but just cover potential losses itself.
Right. And here's a clearer difference. IFRS generally says no, you can't create a provision just for your own potential future losses you plan to self-insure. There's no past obligating event with an external party.
So you just record the loss if and when it happens.
Under IFRS, generally, yes. US GAAP, however, can be different. Under certain specific conditions, US GAAP might actually allow a company to accrue a liability related to self-insurance if it meets criteria suggesting a more concrete obligation exists.
Huh. That's quite a divergence. What about big environmental cleanup costs or decommissioning oil rigs, things like that?
Both frameworks definitely require companies to account for their significant liabilities. But again, the exact point in time when the liability is recognized and the specific methods used to measure it can differ between IFRS and US GAAP. Same goes for asset retirement obligations, the cost of dismantling assets later on. The timing and measurement can vary.
And even just selling off regular property, plant, and equipment, disposal costs.
Yep, even there. The specific events that trigger recognizing the liability for disposal costs might not align perfectly between the two frameworks.
Okay. How about something common like product warranties?
Warranties are generally handled similarly. Both IFRS and US GAAP typically require companies to recognize a provision or liability for expected warranty costs based on past experience and estimates of future claims.
So, some areas of convergence there. Finally, what about legal claims and ongoing litigation? That seems like a classic area for uncertainty.
Absolutely. And under both sets of standards, the key questions are, is an unfavorable outcome probable? And can we reasonably estimate the potential loss?
But the interpretation can differ.
That's the crux of it. How you interpret probable, especially given the potentially higher threshold in US GAAP, and reasonably estimable, can lead to different results. A lawsuit might lead to a recognized provision under IFRS's more likely than not test, but maybe only footnote disclosure under US GAAP if it doesn't meet their probable threshold.
Wow. So the same lawsuit could appear as a liability on one company's IFRS balance sheet, but only be mentioned in the notes for a similar US GAAP company.
It's entirely possible, yes. That really underlines why you need to know which rules are being applied.
It really does. Okay, stepping back then, why is wading through all this detail about provisions, contingencies, IFRS versus US GAAP, why is this so important for you, our listener, to grasp?
Well, because this stuff is fundamental to getting a real sense of a company's financial health and, crucially, its future risks and obligations. These aren't just abstract accounting rules. They represent potentially huge future cash outflows.
They're the potential drains on resources hiding behind the headline numbers.
Exactly. Understanding provisions and contingencies gives you a much more nuanced view. It helps you assess risk better. And transparent, consistent accounting here is vital for investors, lenders, anyone making decisions based on these financials.
Yeah, the IFRS GAAP differences.
They highlight why direct comparison between companies using different standards can be tricky. You need to be aware that reported profit or liabilities might look different, partly because of the accounting rules themselves, not just underlying performance. It impacts comparability across borders.
Okay, great summary. So, quick recap. Provisions are liabilities on the books, but with uncertain timing or amount, recognized when specific criteria, obligation, probable outflow, reliable estimate, are met under IFRS.
Right.
Contingent liabilities and assets are potential obligations or assets, generally not on the balance sheet under IFRS, but disclosed in the notes if certain probability thresholds are met. And crucially, there are significant differences between IFRS and US GAAP in definitions, recognition thresholds, especially probable, measurement, like ranges, and disclosure requirements for all these items.
You've nailed it. It's about how companies account for those future what-ifs and knowing the rules of the game they're playing by.
So here's a thought to leave you with. Now that you've got this framework for thinking about provisions and contingencies, how might it change the way you look at news stories? When you read about a company facing a major lawsuit or maybe announcing a big restructuring plan, what questions pop into your mind now about how that might really be reflected in their financial reports?
Yeah, it definitely adds another layer to your analysis. Maybe take a look at the annual report footnotes of a company you follow. See what they're disclosing about provisions and contingencies. It can be quite revealing about the risks and uncertainties they see on the horizon.